Hello and welcome. Today we are diving into a topic that can cause a bit of stress for pretty much anyone who's self-employed in the UK, the dreaded HMRC inquiry. But don't worry, we've teamed up with the absolute experts at My Tax Accountant to break down exactly what triggers that unwanted attention.
So let's just cut straight to the chase. Is your 2025/26 tax return about to set off alarm bells at HMRC? It's a huge question. And the answer? Well, it might hinge on details you haven't even thought about.
And here's why this is more important now than ever before. Look at this number, nearly £40 billion. That is the UK's tax gap. It's the mind-boggling difference between what HMRC thinks it should be getting in tax and what it actually collects. And trust me, they are under some serious pressure to shrink that number.
Okay, so here's the game plan for today. First, we're going to look at HMRC's massive £40 billion hunt. Then you'll meet their super smart digital detective, a system called Connect. After that, we'll get into the nitty-gritty of red flags for your income and your expenses. We'll cover what actually happens if you are flagged, and we'll wrap up with the best way to stay off their radar altogether. Sound good? Let's go.
Right, first up, that £40 billion hunt. This isn't just a number on a wall chart in their office. HMRC is actively ploughing a ton of money and resources into a massive crackdown on anything that doesn't look right. And let's just look at the raw numbers here. They're spending £1.6 billion over 5 years. That money is paying for 5,000 new compliance officers. Yeah, 5,000, plus another 1,800 debt management officers. They've already boosted their checks by 15%, hitting 320,000 in the last year alone. Their target? To rake in an extra £8.8 billion every single year. The takeaway here is really simple. More staff and more checks mean the chance of you being looked at is going up a lot.
But what's really fascinating is how they're doing it. It's not just about hiring more people. Oh no. HMRC has an incredibly powerful piece of tech doing the heavy lifting. So it's time to meet Connect.
So what on earth is Connect? Well, think of it like HMRC's ultimate digital detective. It is a seriously clever supercomputer, and its only job is to spot things that don't add up. It chews through billions, and I do mean billions, of pieces of data from all over the place to build a complete financial jigsaw puzzle of you, just waiting to find a piece that doesn't fit with your tax return.
And this just shows you how much it can see. It's kind of breathtaking, really. Connect sees your bank accounts, your credit card statements, and what property you buy or sell. It knows what car you drive from the DVLA. It's hooked into online marketplaces like eBay, Etsy, and Vinted. And get this, it can even scan your public social media. So if you're claiming a very low income, but you're posting photos of your new luxury holiday, yep, that's a flag. It pulls data from all over government and even from more than 100 other countries. Honestly, there just aren't many shadows left to hide.
So with that all-seeing digital eye in mind, let's look at the actual red flags it's searching for. We'll start with the really common triggers connected to your income and what you earn.
Okay, number one, big unexplained swings in your turnover. So let's say you're a web developer in London, and one year your income just drops by half with no obvious reason. That's going to get flagged. Another huge one is when your numbers don't match what others are telling HMRC. If your payment processor, like Stripe, says you were paid £40,000, but you only declare 30, Connect will spot that in a heartbeat. Then there are the classics, not declaring your side hustle income, rental profit, or of course any cash-in-hand work. Oh, and constantly reporting an income that's just shy of a tax threshold, yeah, that looks pretty suspicious. And here is a fantastic pro tip directly from the team at My Tax Accountant. You know that £1,000 trading allowance for side hustles? Well, that means you don't have to declare the first £1,000, but the second you earn £1 over that limit, you have to register for self-assessment and declare everything. Their advice is spot on. Just be honest and transparent. It is never, ever worth the risk.
That's not all, though. It's not just about what you earn. Now let's look at where most people go wrong, and a lot of the time it's by accident. Let's talk expenses. And stay with me here. The next point might actually surprise you.
This slide just nails the point perfectly. Look at the difference. HMRC's system is built to hate round numbers and vague claims. Sticking down fuel £1,000 just screams, I guessed. But claiming fuel $978.55 backed up with a mileage log, now that looks believable. Same thing for mixing business and personal use. You can't just claim your whole phone bill, you have to work out the business percentage. And please avoid vague things like general expenses. Be specific, client lunch with Acme Limited, and the date. Detail is absolutely your best defense.
And beyond just bad paperwork, some claims will always raise eyebrows. If your expenses are way higher than the average for your industry, they're going to ask why.
Claiming for things you can't, like your daily commute or a new suit for work, well, that's an easy win for them. And they are cracking down hard on things like R&D tax credits. They've seen some totally wild claims, like a restaurant trying to claim R&D for buying a new fridge. I know, it sounds mad, but it happens, and it's why they're looking at these claims so closely.
And here's a little did you know for you. The National Audit Office actually found that error and fraud in R&D claims was costing us taxpayers over £1.3 billion in a single year. When you hear a number like that, you can suddenly understand why it's become such a battleground, right? The lesson is clear. If you are making a genuine claim, your records need to be absolutely watertight.
So, let's talk about the worst-case scenario. What happens if that letter actually drops through your letterbox? The idea is terrifying, I get it, but the process itself isn't some chaotic nightmare, it's actually very structured. Let's pull back the curtain on what an inquiry is really like.
Right. It nearly always kicks off with an official letter. First rule, don't ignore it. That letter will say an inquiry is open and they'll ask for specific documents, bank statements, receipts, that kind of thing. Your job, or your accountant's job, is to give them what they need. They'll review it all and maybe come back with a few more questions. And then finally, they make a decision. If they found a mistake, you'll have to pay the extra tax, plus interest, and maybe a penalty. See? It's a step-by-step process, not an ambush.
And this is so important. This is a key piece of information about your rights. As long as you file your tax return on time, HMRC usually only has a 12-month window from the day you filed to open a standard inquiry. If that letter arrives after 12 months, the very first thing your accountant should do is check if they're even legally allowed to ask. Knowing this is a massive piece of your armor.
Okay, we have covered the risks and the process. So let's finish on the most important bit, your best defense. How do you proactively make sure your tax affairs are so clean that you never even appear on HMRC's radar in the first place?
I like to think of this as your 4-point compliance shield. Number 1, keep amazing digital records. Scan every receipt, use accounting software. It's non-negotiable. Number 2, be honest and accurate. Make sure your figures match what your bank knows. Number 3, if there is something weird, like that big drop in income we talked about, don't hide it. Use the any other information box on your return to explain why. It shows you've got nothing to hide. And finally, the golden rule. If you have any doubt about anything at all, get professional advice before you click submit.
Because at the end of the day, it all comes down to this simple fact. Dealing with an inquiry is stressful, it takes forever, and it can be incredibly expensive. Taking that little bit of extra time and care to get it right from day one is honestly the smartest business decision you can make.
And I love this final insight from my tax accountant because it just hits the nail on the head. Most of that huge tax gap doesn't come from criminals trying to cheat the system. It comes from genuine mistakes and people just failing to take what HMRC calls reasonable care. Getting an expert to help you is the best possible way to show you've done your bit and taken that reasonable care.
Okay, and before we finish up, just the important legal bit. The information we've shared today is for general guidance. It is not a replacement for proper, tailored professional advice, and you really shouldn't rely on it alone to make financial decisions.
So, if anything we've talked about today has made you think, maybe I need a bit of help, then the absolute best thing to do is speak to an expert. For real peace of mind, we highly recommend getting in touch with the specialists at My Tax Accountant. All their details are right there for you now. Taking control of your tax is one of the best things you can do for your business. For more updates just like this one, make sure you subscribe. Thanks so much for your time.